welcome. Great to see you all here. For those of you who do not know, I'm Colin Mayer. I'm a professor here at the Saïd Business School and at the Blavatnik School of Government, and it's my very great pleasure to be able to welcome you here this morning. I hope you had an enjoyable night being locked up in what I'm sure you now realize the Hotel Malmaison was the former Oxford prison and castle. It was for quite some time owned as a prison by Christ Church, the college in Oxford, who recruited wardens to look after it. And you'll be delighted to know that the wardens had the principle of charging the inmates for food and lodging to convert it into a commercial enterprise. But you'll also be pleased to know that the last hanging occurred in 1952. So we're celebrating this year not only the Platinum Jubilee of Her Majesty the Queen, but also of the last hanging in the Oxford prison. But we've got a tremendous day ahead of us. We've had a remarkable set of submissions to the program, a huge number of submissions to the program. And I'd just like to start by expressing my tremendous thanks to Elaine McPartlin for her organization and administration of this event. It's a huge amount of work every year, and she does a simply tremendous job at it. So we're extremely grateful to you, Elaine, so thank you very much indeed. And I'd also just like to thank my other participants on the organizing committee for spending a great deal of time selecting the papers to be included. We've grouped them together so that today's presentations will be primarily on the subject of markets, labor markets, financial markets, corporate control markets. And tomorrow we move to the subject of ownership, the state, and regulation. And we've got two panels, one today on beneficial ownership and pass-through voting, and tomorrow a panel on public policy towards promoting purposeful businesses. The structure of the days are that each of the presentations will in total have an hour, and we're splitting it up so that we're asking the presenters to present for 20 minutes, the discussants for 20 minutes, and then there will be 20 minutes of general discussion.
Great, thank you so much. Really very honored to present in front of everybody here, so many people I know, and I'm looking forward to the rest of the conference, but I'll jump in. So the title of my paper is The Effects of Hedge Fund Activism. So just give a brief overview of what I'm trying to do in this paper, at least. First, I provide a methodological discussion or contribution in terms of how should we think about testing the effects of some action when we think that the distribution of that effect has a really strong selection component, right? This is very common in corporate governance research, and I think I'm adding a kind of novel technique in terms of how to do that or how to think about it. I then use this method to provide some new evidence on the effects of hedge fund activism. And I end with a brief policy discussion of how I think these results potentially could tie into a lot of current trending topics in corporate and securities. So given the audience here, I'm going to kind of just briefly go through this. I think everybody knows what hedge funds are, but they are pooled investment vehicles where the compensation is tied closely to the performance of the fund, and they face some reduced securities disclosure requirements. And why this is important is because it allows hedge funds to be particularly nimble in a way that some of the prior kind of investment managers perhaps were not. In this literature, we focus mostly on activist hedge funds. So the universe of hedge funds is quite large. But here we're focusing on firms that don't just purchase shares in firms on behalf of their investors, but they try to explicitly change corporate strategy. right? So it's been a really active portion of the literature for the last 15, 20 years. And there are dozens of papers published exploring everything from profitability to innovation and credit spreads. So one thing to note is that there have been a number of legal, regulatory, and institutional changes that have occurred since the kind of early 1980s that have made activism both more profitable and easier to conduct, right? So things like the growth in index investing and requiring institutional investors to vote their shares. They typically rely, because they can't actually do research on every one of the firms in their indices, they tend to rely on the proxy advisory firms who have typically supported activism. So as this has risen, their kind of guaranteed vote share seems to have gone up. The removal of staggered boards over time and the increase in wolf pack strategies have all made this either more profitable or easier to conduct. And at least in part from those changes, what we've seen is a large rise in activism over time. So here, this is just kind of within the data set I have, the unique counts of how many hedge fund activism events were there each year, right? And so these are typically measured by investors filing a 13D filing, as probably all of you read with Elon Musk, right? You're supposed to file a 13D when you plan to be active, saying that you've taken above a 5% stake in a company and that you plan to kind of do something to change company strategy. So what we see is this has kind of steadily increased over time, although in the kind of end of the panel, my panel ends in 2016, the number of events is still kind of below the financial crisis period, the pre-financial crisis peak. As I note in the paper, however, I think this kind of undersells how important activism is today, because activists are targeting much larger companies than they previously did. So in the beginning, kind of activists were, because they have to purchase these shares, they're not taking out loads of debt like a private equity company, they don't want to necessarily get involved with a company where to get this 5% stake or a meaningful stake, they have to kind of invest kind of billions of dollars. They were typically focusing on smaller companies, whereas now there's more capital in the space and they're going after larger companies. So if you kind of look at the total enterprise value of the firms that are targeted every year, it's actually much higher at the end of the sample. Okay, so with this rise of activism, it has generated a kind of spirited academic and policy debate about whether or not this type of strategy is good for markets, right? On the pro side, I think the argument here is that it solves the canonical problem in corporate law, which is the presence and scope of the agency problem. I won't go too far into explaining the agency problem. I think everybody here knows very well what that is. But the argument here is that because hedge funds are as nimble as they are, because they get paid more when their firms do better, when their portfolio firms do better, and because they have some reduced disclosure costs, and importantly also, they don't face the same conflicts of interest that perhaps mutual funds did in the beginning, where they're trying to sell mutual fund plans to the same companies, they perhaps won't be as aggressive as would be demanded. That hedge funds are in a potentially unique position to reduce these agency costs. Right? However, some argue that this kind of has been not necessarily a sanguine development for markets, and the argument here is that they're kind of the archetypal short-term investors, and that in particular this might lead to lower long-term investment, right? Which potentially is a bad thing for markets, at least during this time period. So what do we know already, right? This is the kind of baseline result that we've kind of established in the literature. It's been replicated across numerous papers. Is that the short-run stock return, the stock price increase around the filing of a 13D is somewhere around 5% over the whole sample, right? So if you own shares of a company that is the subject of an activist event, you can expect that those shares will increase by about 5% in the kind of short window that you're holding, right? And this is generally taken as positive evidence that activists are good for markets because they help solve this agency problem and they lead to value increases at the firm. As I note in the paper, if you kind of segment this over time, you do see that these returns have gotten smaller over time. And in particular, they've gotten smaller for firms that remain independent, right? So one critique or benefit of activism, depending on what your persuasion is that what they're doing is they're leading to more industry consolidation. They're forcing companies to get taken over. And that's where all these returns come from. There was a really influential paper by Greenwood and Shore in the beginning of this debate saying that the returns only accrue to these firms. I think it's maybe perhaps not only for these firms, but it's certainly they're kind of driving even the short-term performance when you don't necessarily know exactly which firms will be a takeover, but you might have some beliefs about which type of activists or which type of firms would be taken over. So where did this lead us? Kind of what do we take away from these short-term price changes, right? I mean, I certainly think it's consistent with evidence that this is good for markets or good for firms and good for investors. But the counter side is that this just could be a myopic response to the activism filing and that it's not necessarily leading to fundamental increases in performance over time, right? So Marty Lipton wrote an influential memo where he said, what I want to know is for companies that are the subject of hedge fund activism and remain independent, what is the impact on their operational performance and stock price performance relative to the benchmark, not just in this short period, not just this 30-day period, but going out further than 2 years. Okay? And that's kind of where we've been for the last 10 years or so, I'd say, in this debate. It's kind of trying to ask this question. Is it good in the long term for long-term investors? Given the rise of kind of large institutional investors who are supposed to be managing for the long term in their influence, right? Is this good for investors in the long term? So here I kind of replicate the results from one influential paper written after the Lipton memo to try to address this question. This is a paper by Alon Brav, Lucian Bebchuk, and Wei Zhang, published in 2015. And what they do is they say, okay, well, let's take the long view and let's look at what happens to operating performance and some other measures at firms who are the subject of activist event going out 5 years, okay? And so what they're going to do here is they're going to run regressions, fixed effects regressions, controlling for firm-specific and time-specific effects that might be affecting, that might be driving operating performance. They're also going to control for some covariates. This is primarily market size and firm age, right? And then they're going to present an event study regression to show how this changes around an activism event, right? And here I just kind of plot the coefficients over time from this regression. And the vertical line here is kind of right, time 0 is the year in which the activism event occurs. And the argument here is that, look, this is good for markets because we see that return on operating performance above what can be expected by the model increases after an activism event, right? Consistent with not just selling off firms, but that these firms are performing better. However, one thing you should note from this graph is that there's also a decreasing trend before the activism event, right? So if we want to say, what is the kind of the effect from the activism event itself, what we need to do is put some kind of priors on what we think would have happened to this trend had there not been an activism event, right? If we think it would have continued along the same path or perhaps stabilized, right, then perhaps we can say, yes, activism did lead to an increase in operating performance. However, we know that there is medium-term mean reversion in financial markets, right? It's a kind of well-established result. And if we think that perhaps hedge funds are just really good at picking stocks that are kind of at the trough and that are going to be rebounding, then perhaps we can't say much at all about what the actual effect is of hedge fund activism. So what do I do in this paper? I argue that we need some alternative method that recognizes that these firms are not targeted randomly, right? Hedge funds pick firms for specific reasons for why they are targeting campaigns against them. And I think our estimation methods need to acknowledge that when we're trying to estimate the treatment effects. Prior studies have typically compared firms targeted by activists to similarly sized and valued firms. But it's clear, as I showed in that graph, that there's still residual differences between these firms, right? This decreasing trend beforehand suggests that it's not necessarily the best counterfactual explanation of what would have happened to those firms without an activist event if these changes were already occurring beforehand. So what do? I propose using a very simple machine learning model to try to predict each year which of these firms are going to be the subject of an activist event, right? And then I use the results of that prediction exercise to weight the control firms. So these are all firms that are not targeted within the 5-year window. And I'm going to weight them by this similarity to targets, by the propensity score, right? Which is how much do you look like the firms that were targeted during that time period? And then I'm just going to simply compare the conditional outcomes for the activist targets to a weighted average of these control firms where the weights are set based on how similar they look to the treatment firms based on the propensity score. Right? So just to dig into this a little more, one thing is this is not like some crazy advancement that Andrew is bringing where I'm throwing insane machine learning on this. My argument in the paper is that this is just very similar to the Ashenfelter dip in labor economics. Right? This V-shaped pattern that you see kind of was established in a long labor literature which said if you kind of look at the returns to job training programs, what you see is this V-shaped pattern. So the type of people that engage in jobs training programs are the type of people who kind of are facing labor market distress and that perhaps they would have already rebounded even if they had not entered this jobs training program, right? So starting with paper from Heckman in the 1990s, going forward to Abadi in 2005, and now with kind of this new modern focus on some non-parametric regressions within this framework, what I'm doing is kind of just building on that literature to say how can we control for this selection effect to try to come up with an estimate that perhaps doesn't have as many of these issues. So I'm going to use just an inverse propensity weighted long difference of the treatment effect. So how does this work? So for each year in the sample, I'm going to use a 5-year rolling window to estimate these propensity scores using a logit lasso model and a number of variables argued in kind of institutional literature for this is how hedge funds target firms, right? These are things like prior returns, the institutional environment, analyst following, a number of things that make a lot of intuitive sense for why activists would want to target these certain types of firms. And I'm going to allow the data to tell me what seems to be driving over time this targeting decision. And then I use these propensity scores within this kind of long equation that really all you need to know is that it does two things. It weights control units by the propensity score, right? And then it also removes kind of this residual outcome change that we would have expected to occur anyways based on kind of pre-treatment covariates at the firm, right? This is why it's called a doubly robust method. If either one of these two, either the outcome or the treatment propensity model is estimated in an unbiased manner, then the overall effect should be unbiased, okay? So this is actually not in the paper, apologize, but having kind of heard enough questions through the job market about this, what I've done here is I've plotted just the propensity score distributions for the treatment and the control firms, right? So one question you might have is, are you actually able to do a decent job of predicting this treatment decision in the sample, right? And so this is actually kind of what we want to see in these models. So there's separation between the control firms in blue and the treatment firms, that they're more likely the propensity score distribution is shifted, but they still overlap a good amount, right? If they didn't overlap at all and I could perfectly predict which firms were treatment and which firms were controls, then I wouldn't actually have any valid controls, right? So this is kind of an overlap requirement that you see in a lot of this literature, and this is fairly robust like over different time periods in the sample. What if I did the same strategy, but I just used kind of like what in the prior work has been controlled for, the kind of small set of variables, whether it's firms' prior operating performance, market capitalization, firm age, right? The small number that's previously been used that produced this V-shaped pattern. And what you see is that it's not really able to do a very good job at predicting returns. The treatment and the control firms have very similar propensity score distributions. In particular, in some periods, they almost overlap very neatly, right? So there's not that much that these variables seem to explain a little bit of the differences between the firms that are treated and not, but not a ton. So what happens if I use this method to estimate the effect on operating performance? And what we see now is that there's just very little evidence that, that hedge fund activism leads to long-term changes in operating performance between the treatment firms and a weighted average of the control firms that look similar to these treatment firms, but that were not facing an activist target during that time period. What else can I say with these propensity scores? You know, one question is, do activists actually lead to more takeovers, right? I mean, this has been suggested in the literature. I think there's kind of a good amount of evidence. But what if I kind of look at firms that are similarly situated to these firms? Right? The argument is these type of firms who are underperforming in the short term but that have a good cash balance sheet would likely be taken over anyways. Can I say that hedge fund activism either does or does not lead to more takeovers? What I'm going to do here is for each firm in the sample, I'm going to randomly select another firm using these propensity scores as sampling weights. And then I'm going to look at what's the cumulative takeover probability over the 5-year period. I'm going to do that 1,000 times and present the 95% confidence interval here. And what you see is that even without an activist event, we would expect almost 20% of these firms to be the subject of a takeover within the 5-year period, right? These are the type of firms that would be takeover targets regardless. But if we look at the actual empirical sample of the actually targeted firms, it's well outside of this confidence interval. And in particular, in this kind of 2-year period in the beginning of the sample, the slope is very steep, right? Activists kind of typically hold these firms for 2 years, and it does appear as though even controlling for the characteristics of firms that are the subject of an activist event, that activists might be able to actually induce more of these firms to get taken over. What about long-run returns? This is what everybody usually kind of wants to know. I'm going to subject, you know, there's a caveat that estimating long-run returns in any of these things is always very challenging, but it is what people want to know. So what I'm going to do here is I'm going to separate, because we know, or at least if you believe my prior results, it does appear as though activism leads to more takeovers. Takeovers have a takeover premium, and so there's going to be an inducement in terms of whether or not there'll be higher returns, just based on that sample composition. Thank you very much. So what I do is the top panel is firms that are taken over, and the bottom panel here is going to be firms that remain independent. I'm going to do a similar exercise where 1,000 times I'm going to randomly sample firms, and I'm going to look at what's the return on that portfolio over time. And what we see is that because these firms are kind of, you know, again, firms with good cash balance sheets but that are underperforming, you can see a kind of a wide distribution of what could have happened if you had invested in these firms. If you had been an investor and you said, I'm going to invest a bunch of my money in firms that are underperforming using some strategy, but they're not taken over. This kind of gray shaded region is what you could have expected over time. And what's important here is not necessarily that the empirical distribution of these returns is within that confidence interval, but it's actually very close to zero, right? It's a little bit above. I'm not saying that there's absolutely no long-run returns, but you could kind of expect these kind of return distributions from a portfolio investing in risky firms anyways. All right, so what's my takeaway from this? I think that there's kind of little evidence that activism either increases or decreases operating performance, and kind of the same for long-run returns. What about the other outcomes? As I mentioned, some have argued that what activism appears to be doing is potentially inducing some other significant externalities. This could be lower investment, both at the firm and at peer firms. And that also what it could be doing is shifting kind of from labor to capital. So like we could be shifting labor rents from the workers at these firms just to capital. All right? And can we say anything about that with this method? Now, it does appear as though short-term payouts, so these are kind of dividends and share buybacks, do appear to increase in the short term, especially following an activist event, even, again, benchmarking to firms that are facing these similar trends over time, and that this perhaps is coming at the extent of longer-term investment in research and development and capital expenditures. Leverage appears to increase a little bit, although, as I argue in the paper, I don't think that these results are particularly robust. And if you kind of do a very similar model looking at employment levels at these firms, there's a substantial decrease in the employment level, even again, benchmarking to comparison firms who are also struggling, who would potentially be expected to kind of jettison some set of their employees. And also, this doesn't take into account the fact that when there are takeovers within these firms, we know there's going to be a lot of layoffs typically in takeovers, and those will drop out of the sample. So I think it's a kind of conservative estimate that it leads to about, and this is about an 18% of the pre-treatment average in worker levels. Okay, I only have a couple minutes. I'm going to briefly get through. Do these results kind of speak to any of these current policy debates? I argue that they potentially do, right? I mean, there's a discussion about mandatory universal proxy access, regulating wolfpack tactics, changes in the 13D reporting requirements to shorten the window for when you have to disclose, and the rise of potentially an anti-activist poison pill that Delaware has for now killed, but you never know what could happen when it gets to the Supreme Court. My argument is I don't think we want to go to a world where there's no activism, right? I don't think we want to get back to an 1980s period where managers are purely entrenched, right? I think what we want to do is say, what is the type of activism that at least the big players in the market state that they want, right? Like, is there a way to kind of use, instead of a cleaver, to use a scalpel here, right? And so my argument is that we can rely on the institutional investors, at least as a first pass, to potentially play a more robust role within the proxy fight game, right? And so, you know, the letter from Larry Fink every year to the CEOs, as many of you I'm sure know, have said that we've long believed that our clients as shareholders in your company will benefit if you create enduring sustainable value for all your stakeholders. In particular, they've explicitly said we want to see less of a focus within our portfolio firms on short-term kind of share buybacks and dividends because we're holding for the long term. We want to see more long-term investment. We want to see you consider and take into consideration the interests of your employees, right? And so given the role and the size in the market that institutional investors have, I think that they're able to be much more active in this space and say, you know, we're not going to say that we're never going to vote for activists or activism, but we only want to vote for the type of activism that we think leads to the type of changes in markets that we are rooting for at this time. Okay, to conclude, activism has risen in scale and importance, generate a lot of controversy. I think as a baseline matter, we at least need more caution in attributing changes in long-run stock prices and operating performance around activism events, given how strong the selection issue is. It does appear to change payout and investment strategies, and does appear to be accompanied by substantial layoffs. And to the extent that institutional investors are serious about changing managerial focus from solely shareholder wealth maximization, I think that this is one place to start. It's really hard for me to think about when BlackRock and Vanguard say that they want their firms to be better on ESG measures. How do you measure that at the firm level is a really challenging question. The data sets aren't good. I've used them. I've looked at them. This is one area where you're looking just kind of at explicit change where we think maybe we can estimate these things better. And I think this could be a first start for them to kind of put their money potentially where their speaking has been. Thank you very much.
Okay. Thank you. Thank you very much for asking me to discuss this interesting paper. Yeah, I did some research with Nick on activism, so it's an area that I find super interesting, and it's growing and growing. So it's a paper on a very important and timely topic. And Andrew's paper is it presents actually a very balanced view of the activism literature. So it was very useful for me to kind of see the research done and pluses and minuses. But I'm going to be on the opposite camp, I think. In terms of like what I think about activism. So there is a very large literature now on activism, and this literature finds very important outcomes of activism, right? So when they arrive, there are very sizable returns. Like a couple of days ago, Unilever got targeted by an activist, and their stock price increased by 7% in one day. Right? Then there is increase in payout, increase in leverage, reduction in investment, capex and R&D, but yet there is better, more productivity in innovation in terms of patents. And there is increase in takeover likelihood, but this is a little bit more nuanced than just saying, you know, firms become takeover targets, because maybe 50% of the targets are sold completely to new firms, but the remaining firms also, they exhibit a very different M&A strategy than before. That's again my work with Nick. We find that actually they stop making empire building acquisitions. They engage in divestitures, spin-offs, carve-outs. So M&A activity, volumes go down, but the quality goes up. And there is increase in managerial and board turnover, right? Like there is a lot of change in CEO or the board members. And again, Nick and two other papers actually show that there are very significant spillover effects, right? When we have a control sample, let's say, but that control sample is also affected by activism. Sorry, I did something wrong. And like industry peers of targets, they exhibit behavior which is very similar to what's happening at targets in terms of capex, in terms of capital structure, payout. A new paper shows that their actually M&A behavior becomes very similar to target firms' M&A behavior. So then I think in Nick's language, it goes beyond the target firm. The effects goes beyond the target firm. So, and you know, most of these things I think are good things, and that's why in my view there is an increase in the stock price, a very sizable increase in the very short run. But Andrew's point, or Andrew's paper, is motivated by this quote from his paper. He says, we observe this 3 to 7% announcement returns in the short run. This could be a reflection of good things happening at the target firm, or it could be a reflection of, you know, a lot of like myopic, opportunistic investors anticipating that these firms will pay a huge dividend, or they will be sold to a new buyer at a very huge premium. So let me get in and let me get that premium, let me get the dividend, and then I will just leave, and I don't care about the long run potential or performance of these firms. So he is trying to address kind of, do we have any evidence for this second view? And he proposes a new methodological approach to kind of construct a control group by using more information at a more granular level and machine learning technology, so super interesting and sophisticated. And with this methodology, he actually finds that, you know, activists are neither good nor bad, but they lead to a lot of layoffs, right? So maybe they are not that good because maybe employees are getting hurt, right? So that is kind of my takeaway from his paper. He doesn't say activists do terrible things, but there is not much happening in terms of improved performance. So my first comment, and it's not really specific to this paper, I read this all the time. So there's like either we will observe good things happening in the firm, or there are some myopic investors, right? They are responding to anticipated increase in payout and takeover likelihood. And we are very myopic. We want to get into these firms. That's not very clear to me why it is myopic, right? So I'll come back to this. There are papers, theoretical papers, and a lot of empirical papers showing that when firms pay dividends, it's a very good thing, right? Activism literature, or maybe Andrew thinks, we are robbing the firm off. They won't have any capital after they pay dividends, so they won't invest and they would perform very badly. But that's not how we view dividends. Dividends actually they serve many purposes, right? It is just there's excess capital in a firm and it is reallocated to some other firms which need that capital, which is a great thing. And the firm which is paying these dividends get actually a price for doing that. And also there is like a signaling aspect. There are good prospects in these firms, or there are not empire building managers who are investing in bad projects. So then I may actually observe an activist coming to a firm and I may say, okay, dividends are super good. It's not that I am interested in that dividend. I think that they serve these purposes. That's why I buy the firm's stock and the price goes up. With takeovers too. Of course, there are very bad acquisitions, empire building acquisitions, but there are also very good ones. It's a mechanism to allocate resources from less efficient users of those resources to more efficient use of those resources. Plus, if a firm doesn't do well, it gets taken over. There is market for corporate control. And if activists facilitate that, I don't see any problems with that, right? They generate 50% returns premium. Then maybe the buyer is making a mistake, but it is their problem. If activists are selling my firm at a 50% premium and I get it as an employee or as a shareholder, it is not something bad for me, and the stock price increases as a reflection of that. That doesn't hurt me. So, right. So I think I already made that point. And then the next quote from Andrew's paper says, my results are consistent with hedge funds pushing firms into takeovers while increasing short-term payouts to shareholders and decreasing firm investment. I think I already said these things, but again, pushing firms into takeovers can be a very good thing, right? And I want to mention this earlier paper in JF. So that was one of the first papers I read when I was a PhD student. It's interesting. It shows that actually good firms pay dividends to signal their prospects, right? Good prospects. But after they pay dividends, their stock price goes up and they issue shares and they do investment, right? Again, this makes the earlier point that I was talking about. And reduced investment, reduced capex or reduced R&D, we see this in Andrew's paper and in earlier papers. Again, this is not necessarily a bad thing if there was overinvestment. But I think I want to make another point. I don't think right now we are measuring investment correctly for today's firms. The reason is that we always look at capex, right? Sometimes R&D, sometimes M&A. But today's firms are very different from firms 50 years ago. They are actually not, only investing through capex, R&D, or M&A. Yes, M&A, but they are buying a lot of VC-backed startups. But these VC-backed startups are not going to be in our data because these are small and very innovative. Transaction values are missing. Unless we count the numbers, we are going to miss them in our M&A data. And they are investing $1 billion in startups through their corporate venture capital arms. A couple of weeks ago or months ago, there was a $2 billion investment into a startup by Lego and Sony, right? And so most productive, most innovative investments are happening outside the firm boundaries. And I think we are not measuring that at all. We are missing that. I'm working on a new paper on that. So it is not clear to me, existing papers or Andrew's paper provides clear evidence that activist targets are reducing investment. When we incorporate this, actually investment increases. But this is not a traditional way of looking at investment. And here I want to complain about something. This was very confusing to me. So we look at targets, right? And then some of them remain independent, some of them are taken over. And earlier papers, or your point was that most of the results or performance improvement happens in those firms which are taken over, right? We look at their stock price, operating performance, employment. But in my knowledge, and I did a lot of work on M&A, we actually stopped observing those acquired firms, with a very few exceptions. Like if you look at LinkedIn, which was acquired by Microsoft, yeah, we see everything about LinkedIn. Or Slack acquired by Salesforce, we still see Slack as an independent firm. But I would say 90% of M&A deals, the target firm disappears. So there is no stock price, there is no operating performance, there is no employment cuts. So I am not really getting that comparisons when we look at targets and non-targets. So measuring effects of activism, I agree with Andrew, it's a very challenging task, right? First thing is, what is the control group? And even if we have a control group, again, Nick's paper shows that that control group changes their behavior as a response to spillover. Like, they respond, they don't want to be taken over. So they do what is observed at activism targets, but also targets when we match them to a control firm at t equals 0, they are going to change enormously after that through this asset restructuring. 96% of activist targets go through asset restructuring, buying, selling, divesting. So then, again, this is what we found in our paper with Nick. Target firms get much smaller, first of all. They do a lot of asset sales, divestitures, right? So these assets are bought by some other firms. And then also, there is a considerable amount of spin-off and carve-out activity. So there are newly created public firms, like GE. Now GE is becoming 3 firms, right? So then when we have a target like GE initially, then we get 3 GEs. Which one is, it's not even clear who is now the activist target. I think we keep tracking the one which is called GE, ignoring what is happening in the new firms, which are spun out of old GE, but their performance should be included, right, in the performance of the activism target, because they don't disappear. They do actually very well. Spin-off studies, carve-out studies show that they do really well in terms of like outperforming their industry peers. So again, this is not a criticism of Andrew's paper. I think all activism research, like I just thought about this after we did our paper, we need to take this into account, right? We need to combine those 3 GEs into 1 GE, because 2 GEs are created because of activism. And for employment, exactly the same thing, right? We see 18% reduction in employment at the target that we track, but the asset sales, divestitures, or spun-off units and carved-out units, they have a lot of employees. When we include those employees, I don't know, maybe there won't be, maybe there will be even an increase in employment, because these firms are smaller, more nimble, more focused, and the point of separating them is to realize their growth options more efficiently. I wouldn't be surprised if total employment goes up. Yeah, I liked Andrew's V charts. They were very interesting because they show us that these firms are on a downward trajectory before they are targeted. So, of course, activists are very smart. They are going to select firms which are not doing very well. But what is very interesting to me is if activists were selecting only, right? Sometimes they would come like at -1, sometimes they would come at +1. They won't be perfectly timing their arrival, right at that precise magical moment where the rebound starts, right? That's, I think, too much for me to accept. So they must be doing something so that that rebound starts. In all charts, right, that 0 activist arrival coincides with the beginning of the rebound. But let's say they only select, right? I think as a profession, we complain about that. VCs don't do anything, they just select. PEs don't do anything, they just select. Activists don't do anything, they just select. But selection is not a straightforward task, right? When we have a big firm in an industry, it's not that easy to understand if it's a good firm to select, right? There's a lot of asymmetric information. There are a lot of economic activity, business activity. And if they are selecting in inefficient firms and telling them increase dividends, increase leverage, reduce capex. These are not rocket science ideas. But I think they are bringing those firms into spotlight. And this is kind of what a Wall Street Journal article says, what happened with PG, right? The activist investor came to PG. Everybody maybe knew that PG was not that efficient, but it accelerated the process. And now the same activist investor also who was at GE came to Unilever a couple of days ago, and yeah, people like it. Even like institutional investors of Unilever said, yeah, this is a very good thing. We are actually supporting him. So they bring, I think, a sense of urgency, and so then we create value because improvements happen earlier than later. Your point is maybe they would have happened anyway, right? Maybe the firm would hire a new CEO. They would not have happened, I think, if the firm stays exactly the same, but there are other mechanisms to create efficiencies. But if activists are kind of accelerating them, there is time value of money. The earlier we get these improvements, the more value we create. And yesterday, yeah, I'm sad not to see Marco and Joseph, but they were talking about like COVID and how firms react to COVID, the resilient ones, less resilient ones, small ones, big ones. And I was thinking about Andrew's paper and their kind of remarks at the end of the day. So it could be a very interesting exercise, actually, to look at how activist targets did during the pandemic, right? Because their point, Joseph and Marco, they were saying that, like smaller firms, risky firms, they didn't do well, more resilient, like more stable firms had greater ability to storm the pandemic. But this article, again, the same article from the Wall Street Journal says, actually, PG did extremely well. They outperformed their competitors. And it was actually due to this activist involvement because they brought a lot of like operational efficiency, organizational structure got simplified, executive compensation changed. So yeah, I think it's a good idea for a paper. Like there's so much activism targets, right? If activists are hurting these firms, they should do really badly during this shock. So yeah, I thought this is really interesting that like PG's overperformance is attributed to that activist who was there, by the way, 3.5 years. Because another criticism for activists, right? They come and they increase payout, they get the payout and they leave. But this guy stayed there for 3.5 years and implemented a lot of changes. These changes are not very easy things, And now he's at Unilever. So I don't see, how they don't do anything. So I really like the paper, how it actually looks at pluses and minuses and this methodological contribution. But again, given what I read in the academic research and like anecdotal evidence, because there is an article almost every day about a firm in S&P 500 getting targeted by activists. So it's a bit hard for me to believe that they don't do anything, just selection, and they are neither creating value nor destroying value. And if they are not doing anything, it would be hard for me to justify the existence of this $3 trillion industry. And Andrew's results, right? Like they don't have superior operating performance or stock price performance of target firms, yet they actually have less employment, right? Less capital. So to me, that's more efficiency. With less inputs, you are generating the same performance as control firms. That just means they become more efficient. Yeah, so that is what I have. Thank you very much. Yeah. Sure.
Sure. All right, thanks.
Andrew's response.
Great.
And then we'll open the floor again.
Great. Oh, sorry. You can just leave my slides off. It's fine.
I'm trying to sort out that PDF thing.
Oh, okay. Gotcha. All right. Well, I'll just start. So thank you so much. Those were really, really thoughtful comments on the paper. So I'm just going to briefly touch on some of the points you made and then open up the floor. So one, the spillover is totally true. I mean, it's hard about this whole literature. You can assume that there's kind of two reasons that you could have these difficulties estimating the effects. One is that we have these time-varying trends that you need to control for, which I think is what my work is trying to do. The second is that you have these spillovers that make the comparisons not potentially valid comparisons. And this doesn't do anything to address that, right? I have ideas for where to go forward with that. I'm waiting for, there's some better governance data, and I think the point you want to try to do there is find a set of firms where you can credibly argue that maybe spillovers aren't going to exist as much, right? My idea is to get this better governance data that's been put together by Eric Talley and co-authors and try to say, can we identify firms where for governance reasons an activist event's just simply not really feasible or very unlikely, right? You think about Mark Zuckerberg, you think about all these other places. Now, they could still have these time trends in performance, but they're not necessarily going to be that worried about an activist coming to target them. And right, can we kind of split samples in that way? Not perfect, but I think it's a way to try to get at this. Two, are these things good? So I want to be clear, like you can take these results, my empirical results, and tell whatever story, you have to always kind of have your own background priors about what this means. And I think it's perfectly fine to say, I'm okay with more takeovers and less investment. We think empire building is still a huge problem, and this is kind of what this is supposed to do. Totally fine. I think for me, there's a whole literature now in finance trying to understand it. Now, maybe we're just measuring investment wrong, right? But if you look at Philippon and Gutierrez, they're kind of arguing, like, we don't know why firm investment is so much lower than it used to be. We don't know why productivity appears to be lower. Could this, in this kind of rush to kind of enforce kind of CEO discipline, be explaining some of this underinvestment, potentially, right? In addition to the thing for takeovers, right? I think there's an argument why in this literature it hasn't just said, activism leads to more takeovers, this is good, we like activism, right? I mean, for the most part, it's a harder sell in 2022 to say, let's have more industry consolidation. At least that's my read of why that's not used as a primary justification. But like you said, the market for corporate control is a known governance device. There's no reason to think that because I show there's more takeovers that is bad. Like, I just think, within the tenor of the debate, I don't think, if you said to Marty Lipton, look, it's leading to, you know what I mean? Like, it's leading to more dividends and share buybacks, it's leading to less investment and more takeovers, he would say, okay, that's what I think it's doing, and I don't like that, right? And I don't think BlackRock likes that, and so I'm going to appeal to BlackRock. But that depends on what your read is on the game that's being played. Finally, asset restructuring, totally fair. That's something that I need to, so I started working on this project because I actually have other projects that I was working on about activism, looking at things like workers' outcomes, environmental effects at firms, trying to see is there's this trade-off between shareholders and stakeholders. And then I realized that there were all of these kind of difficult issues with the estimation, that I was getting these kind of crazy results, and I wanted to spend the time figuring out how can we think about estimating this. But from the workers' end, with the asset restructuring and all that, to really do that well, you need to get administrative data, which is what I'm working on now. So it's census data, some of the data that Alon has used in his plant level data, where you can see these plants as they change ownership, and then you can estimate these things much more precisely. It's very hard to do with CompuStat data. Finally, the perfect timing, this is an average, right? So it's not like every single firm has a V that picks up right afterwards, but when you take the average, you actually see that with the control firms as well, like the weighted average of the control firms. Because when you're taking an average over something, the timing seems to be happening around then. And lastly, the COVID effects thing was actually something that I wanted to add to the paper during the job market and just didn't have the time. Looking at firms that were targeted and how did they deal with it. I mean, you could tell two stories. One is that they're more efficient and more nimble. The other is they have less cash on their balance sheet to withstand a market crash. Did they have to take out more federal loans? Did they have to issue more debt? What happened? I think it's a really interesting story to say, could there be a trade-off of having a much thinner balance sheet when things get really turbulent? So with that, thank you again. Those were really, really great comments, and I'll open the floor.
So Nick first, and then Jeff. And then...
okay, so can you hear me? Yeah. So Nick Ganchev here. So I'm very happy that we see a new paper on activism. There's been a bit of a lull in the past few years, and I myself have stopped working in that area for some time. So I have a couple of comments. The first one, the propensity score matching approach has been used, and it has had a lot of criticism. And I just wanted to mention that Rui has a wonderful paper about using a structural approach on activism. And in fact, in that paper, he and co-authors showed that something like, if I remember correctly, 3/4 of the value coming from activism is actually treatment, and a very small fraction is actually selection. So in some sense, you want to look at that. But my other comment is about the propensity score matching. So it's very difficult to use propensity score matching here because of the timing, but also because we did an exercise in one of my papers where we tried to use, similar to you, not as sophisticated, but a propensity score matching approach to see how many firms will be targeted. And it turns out that based on all the characteristics that we know, the ones you use about in your table too, it turns out that every year there's about 1,000 candidates that will be activist targets. Of them, very small fraction get targeted. Now, what determines the firms that get targeted is actually things are very difficult to capture. It's exactly this dip, it's the market conditions that allow the activists to accumulate a block to start the campaign and for activism to emerge. So in that sense, this drop that you say, it actually in some sense biases the results, is actually what makes activism happen. And so in that sense, without being able to properly capture with propensity score matching, I'm not really sure about what we can conclude from the results after. That's it.
All right.
Can we
Oh, yeah. Yeah, of course.
And then Jeff.
Thank you. I actually have two questions, quick questions. One is if you can correlate your selection effect with the stock return announcement, the announcement returns. And the other question is, one thing that we found in our paper was that the experience of the activist investor mattered a lot for future outcomes, and whether you have something like that, something to say about that.
Great.
Is this working? Is this working? Hello? So I'm Jeff Gordon. I mean, I've seen a lot of these discussions of activism over time. The activist doesn't do anything. It's not self-executing. It fits in a governance framework, and unless the shareholders are agreeable, you're a gadfly. I mean, I think that's a fundamental issue that a lot of the literature completely ignores. That whatever the concerns we may have about the activism approach, the shareholders are the least of those concerns, right? It might be that there's a distributional element to be addressed. I mean, that's essentially kind of, you've hinted at in employment data. Maybe there's an ESG element to be addressed. Maybe there are externalities generated. But thinking about it from the shareholder point of view, I think is they don't need protection from us, right? And it's not like it's a naive group of unorganized shareholders who are supportive of the activism movement over time. I mean, it seems to me that one of the things that would be pretty easy to do in your data is to break out as to who the activists are and which of them generate the best returns, because part of the claim that Ron and I made a while ago is that there's kind of repeat play. Firms get a reputation or not for generating returns that can be observed. So this all fits in a governance framework. And if you're concerned about the activism, being excessive from a shareholder point of view, then why not look at the governance elements, right? What's the story with boards, et cetera? But I mean, I must say the sort of the, a final point in terms of investment in R&D, this is a public market examination, right? And so the fact that considerable R&D may happen elsewhere in the economy is not an unimportant element to assessing the welfare effects overall. And this kind of fits the point that maybe R&D occurs, with startups that are basically bought. So you can't make any welfare claim about whether the activist movement has effect on R&D unless you're prepared to look at the economy as a whole and see pieces of it that may fit together and work. I guess that's a kind of a sort of a fierce reaction to this general approach, which thinks that looking at the shareholder returns is really the key issue in the activism debate.
Great.
Can you respond shortly?
Shortly.
Because we have two other people.
All right, we'll do that. So first with Nick, I'm not P-score matching here is one thing, right? So I don't actually need those firms to necessarily be that they were going to be targeted that year, that they were up, right? The goal here of all this called design-based inference is to try to say we're stuck in a hard selection on observables world. What's the best way to think about constructing a counterfactual? In a non-structural world, all of these different causal inference approaches, what they're doing is imputing some counterfactual and looking at what happened versus the counterfactual. I think that this is a better approach to computing that counterfactual stuck in the world we're at than just saying, well, let's look at firms in the similar size decile. You know what I mean? I don't understand that. At least this is saying, what are the factors that drive activism in the data, using much more of it. And so you're saying you need to control for the dip. So within this propensity score approach, it is controlling for 1, 3, 5-year returns, change in ROA, right? So that is a predictor that I'm trying. That's part of the reason why you see that the pre-trends are flatter is because that is a strong driver, and you see that constantly getting picked up, right? Okay, so that was one. The experience of the activist is a really good point. That's something I need to explore further. Right now what I do is I do some splits based on the type of activism. So this is a paper from Nicole Boyson and co-authors, which is purposeful activism versus non-purposeful. Another way is I know Frank Partnoy and co-authors have some approach where they actually do the splits based on the activists themselves, looking at kind of the ranking of the activists, and that's totally another valid approach that I should do. Because surely there is some heterogeneity here, and I think that there is a reputation story to be told about certain of these activists are able to generate these returns. Everybody's trying to figure out who they are, and that could be another story. And then just very quickly with Jeff, I totally agree with pretty much everything you said there. I think it is about investors. That's why the end of my paper is saying the large investors in the marketplace today, at least their words that they send in their CEO letters are, we are buying for the long term. I don't want to see short-term changes in payouts. Now, I'm not taking a large normative prior on whether or not payouts are bad or good, but the investors themselves are, and they have a large role to play. And that's exactly why my argument in the paper is if they really mean this, they're the key governance player here, and they should at least think harder about what type of activist interventions they're willing to support. Without the big three investors, it's very hard to think about getting a proxy campaign through at the firm.
Terrific. So we have Olga's, Jennifer and Ron. So Jennifer first.
Yes, I just had a comment that followed on from Jeff Gordon's point and also the point about the experience and reputation of activists. I think that Nelson Peltz is a great example in that regard because, before P&G and before Unilever, there was DuPont. And, a key player in the DuPont was the proxy advisors. It was when ISS came in and advised the institutional investors to vote with Nelson Peltz that everything changed at DuPont. And so he really has built up a reputation over a significant period of years.
Is this working? Yes. So Andrew, since you brought up the big picture, I wonder what your view of the big picture is. So your view of the big picture is that the activists actually don't do anything. The returns come from nothing. That's your first part of your paper. So then the question is, what are the activists thinking? Why are they spending all that money trying to do all that stuff? Are they just deluded? Is this that they're playing to the investors who don't understand this? What's going on? And also, if it is all just selection, then does it mean that all the stuff you otherwise are documenting or claim to be documenting, like reduced employment, that has zero effect on returns? I just wonder how this all fits together in your world. The alternative story is easy. Even the story with negative externalities is an easy story. But your story seems to me a bit, I can't quite fit it together.
From you.
Yeah, I guess I've been thinking more about some of Merih's points about spillover effects.
Yeah.
And it seems to raise issues about who would be the appropriate controls. And clearly, if any of your controls end up later becoming targets, that's obviously, at that point, they should presumably be dropped.
They are, just to be clear right now, the way my sample is constructed.
But I guess the other question is, are there certain types of firms that are unlikely to be activist targets because of maybe their ownership structure? If they've got concentrated ownership structure, then it seems like those in some ways might be more attractive because they won't have the spillover effect.
That's exactly what my plan is for the next approach. The problem is that the governance data that we all use is like really not very good, if we're being honest. Like the ISS data that we use, it's like every 2 years, it's been found to have massive coding issues. And so there is new data coming out that I'm waiting for, that I've been promised and has not still arrived in my email inbox. But the goal is to do exactly that, to say, are there firms where we expect the trends to be similar, but the spillover is just a less convincing story for institutional ownership reasons, for specific governance provisions, and then splitting the sample in that regards, right? So still kind of controlling for the trends in those firms, but splitting out the firms where we don't think that the spillover would happen. It's exactly kind of what I'm thinking for the next step. And I'll just end because I know I'm over time. What is my big story? Like I came into this project not really as, I was kind of perfectly okay with whether or not this increased returns. The story that I'm interested in is everybody in economics, finance is trying to figure out what has happened since the 1980s. And why has it been that the labor share of corporate profits has kind of plummeted, right? You have all these stories that are monopsonistic markets, the rise of superstar firms, right? I think that governance is a natural story because if we are fundamentally saying that labor has less bargaining power these days than it used to, bargaining power is largely driven by these governance measures, right? And so my kind of grand story is that I think that there have been large shifts. CEOs get paid more nowadays in stock-based compensation than they ever did back in the days of kind of like CEO entrenchment, right? That there's been this trade-off where they're working on behalf of the shareholders much closer. They're getting paid more. And where do those gains come from? Could they potentially be coming from the labor, from the shifting labor rents? So this story is to say I need a way to estimate these things. Now, overall, I'm finding very little effect. Right, so why would they do this? Martin Kremers has a good paper showing you're still able to make a lot of money even when you don't drive performance changes. Okay? Because even if you just assume the only effect here is this takeover premium, they have a window within which to trade to make money before the earnings announcements. And I'm certainly not arguing that they're not earning great returns for themselves. I mean, I think the evidence is pretty clear that hedge fund activists do very well. Not all of the time, there have been down periods, but I think that it's not a terribly hard story to say you're not driving fundamental improvements at the firm over the long term, but you are able to accrue rents yourself by trading in advance of your 13D filing.
Thank you. So join me in thanking Andrew and Merih for a great session.